Today, we are fortunate to be joined by Peter Grandich from Peter Grandich and Company and Dave Suckey from C&A Financial. It's a universal concern, financial planning. Will we have enough money to last through our retirement? And there aren't a lot of alternative options to the traditional financial planning model. Today, we're going to talk with Dave about an opportunity he has with his company, a bit of an alternative model to the traditional plan. Dave and Peter, welcome to Ron's Basement.
Well, it's good to be back with you, Ron.
Yeah,
Ron,
Dave.
thanks for having us on. Yeah.
So Peter, you've done a lot of things during your career in the financial services industry. One of which you like to mention as being part of what you call an alternative to the traditional financial planning process. Why do you call it an alternative? And is it something that most investors could benefit from?
Sure, Ron. So for now in the 40th year, the vast majority of people know me from my involvement in the metals and mining industry. But all during that time, I wore a second hat, and that was being part of a planning group based here in New Jersey that Dave and I have been partners with in almost 25 years. The most ways people know finance, first of all, let me just tell you a couple of facts which are kind of scary. After seeing this, Ron, for 40 years. First of all, you'd be surprised how many people do not have any financial plan, any real plan written, including people of wealth, not just, because they don't have anything. The second type is most people then get caught in doing what we like to call needs-based planning. Oh boy, I got to save for my kids' college. Oh boy, I got to save for retirement. They focus on one, and unfortunately, the other ones don't get the attention that they deserve, and they end up with an issue. But by and large, most planning that's done through the financial service industry, what we like to call traditional, is basically trying to make your net worth increase in order to achieve one or more of those goals that you may be able to. But where they don't have a certainty or near certainty that that's going to occur, even though it may sound very good when they speak to you, is if you read in the disclaimer where it says past performance may not necessarily be indicative of future results. And the vast majority of people realize that. And part of that reason is this, Ron. It's not that every financial advisor is not good or anything of that nature. Is there's no certainty in speculating or investing. We've all learned that. We've all thought things should go up one way and they went the other. But what you can have control over, and where Dave's expertise comes in, is how you manage your cash flow. Talk to anybody that's been in business or a real estate investor of any size, and they'll tell you that success was hinged not on their net worth, but how they manage their cash flow. So basically what we do, and Dave can expand on it, is we become efficiency experts. Almost everybody has what we like to call lost opportunity costs. They're losing money in some way or fashion, either paying too much taxes. You may have a great stock market person, but your lawyer or your accountant that's handling something else doesn't know that, and there's no kind of cohesiveness. That's another thing that is missing in financial plans. But by and large, we consider traditional financial planning is the goal of increasing net worth. We've seen too many people fall short on that, but we found when we can make you as efficient, as effective as possible, we can add 20 or 40% more to your savings without any additional risk. In fact, many times less risk.
Interesting. David, can you expand? Why do you think cash flow is more important than chasing net worth?
Yeah. So in doing this almost 25 years now, what I recognized was this years ago. Cash flow is for us. It provides our lifestyle. It provides our standard of living. It pays our bills, right? It's what we go on vacation with. It's what we build future net worth with. The net worth we really accumulate over our lifetimes, for the most part, is going to wind up going to somebody else. And if we don't have proper planning, like Peter was just talking about, it might go to the government. It may wind up going to family members you don't really intend it to go to. And that's very important, critical for when we teach people around how we view money. It's through that cash flow lens that wealthy people have gotten wealthier over time. I was taught this at a young age, getting into this, which was you are your best asset. And if you measure your wealth based on what produces the most cash flow in your life, For most people, it's what they do for a living until they get to a point that they've amassed assets in real estate, private business holdings, even maybe the market with dividend income that's greater than that, that cash flow that we earn every year. That is the best asset. So we teach that. We teach that through life. Oftentimes, cash flow gets mismanaged because, let's face it, in today's world, look how busy everybody is, right? Between the devices we carry in, every day, to all the stuff that's going on in our worlds, everyone has their, what I call, own private economy that they operate in. And for the most part, they don't have a CFO of that economy. We use analogies all the time to explain these concepts to clients. One I like right now is, an NFL quarterback, as an example, comes into a huddle and can organize everybody on the same page so that the outcome can be better. That's what we really do additionally for clients, as Peter mentioned, is they all have a junk drawer, and there's stuff in that junk drawer financially that they made decisions on years ago that may or may not be optimum in today's economy that they live in. So we're oftentimes filling the gaps there first, and then teaching them how to build wealth through cash flow engines that they can create. And then eventually, when they want to stop working, which is the desire of some people, I always say this: they're going to exit the workforce one of two ways. It's either voluntarily or involuntarily. I hope and want our clients to be able to do it voluntarily with confidence and certainty.
Yeah, it's interesting to me, a couple things you said. Number one, it's hard to put this into words, but for a lot of people, like you said, they have a junk drawer, or they're not making smart decisions, and they're finding themselves in a situation where they need to work much harder. And if they would invest some time in planning and strategy, I think is a better word, they could greatly increase their cash flow. Is that a safe way to say it?
Absolutely. And when you can identify inefficiencies in our worlds, and we all have, from people that are worth a lot of money to people that are just starting out, because it's not what they do every day. So if you can shine some light on that and then be able to pull that money back to what we call our side of the ledger, and then be able to put an interest rate on that over our careers, that's a lot of wealth. And that had nothing to do with the stock market, and nothing to do with commodities or real estate. It had to do with being efficient. So, Ron, we'll teach what I call the 3 R's. The first is rate of savings, how to become a world-class saver. That takes pressure off of your money for the unexpected things that happen, which is the next R, rate of return. That's the one thing we don't control. Regardless of where you invest your money, we don't typically control the rate of return. Now, we can invest money in certain areas that maybe have more profitable rates of returns than others based on risk management and all the things that go along with that. But that's yet the one thing that most of the industry focuses on, is my rate of return is better than yours, and no one actually controls that. And the final R, which is critical for people who are getting close to retirement, is having an efficient plan for rate of distribution. Right? And you can control that in your retirement years through strategy, through cash flow management. And that takes the pressure off of the rate of return, which is what a lot of people live on. And Peter will say this a lot: we don't want you to have a plan of hope, right? Especially in this economy we're all in and going, I think, further going in, because it may not be that clean, right, for a while. So it's important to have that efficiency up front and then all the way through, and it helps with your wealth building.
The other thing you mentioned that I think is warrants a little more attention is that and correct me if I'm wrong on this, but you look at the strategy, but not just from the financial planner's perspective. You may have a tax person look at it, an attorney look at it,
right?
Because there are so many parts that, and it's very, very complex. I mean, for somebody who doesn't do it every day, it's a daunting task to try to manage all those components at once.
One of the things you'll find is, and this goes more to the business owner or somebody that's involved past just punching a time clock. They may have a multiple of different types of people that are assisting them. They may have a financial advisor that's handling investing. They may have a real estate person they're dealing with, an attorney, a CPA, a business strategy partner, and all. But did they ever have them all ever in the one room to coordinate everything together? And what happens is, since they didn't, unbeknownst to the others, many times we find one is taken away from the other. And it's actually a net negative at time. And that's where the efficiency comes in. And that's, in a sense, what Dave likes to say is we really end up being their quarterback. And one other thing that's real important before we go on, and this came from all the years of working with professional athletes and teams. The other thing that most people don't have is when they don't have that written plan, or they also don't have a plan B. They just have plan A. And many people in the last 2 years learned that you need a plan B. And when it came to it, that person didn't have it. Now, they're hoping plan A revitalizes itself and turns back to what they hope it will be. But like Dave said, hope is the most important spiritual strategy, but it's the absolute worst investment strategy. And that's why I think having written plans and a written understanding on, yes, this can go well, but if it doesn't, what do we do here? I think that's the other thing that our alternative offers that you don't see in the other plans. They're all just one-way streets.
Yeah, I think my impression, and I talked with Dave a few weeks back as well. I left that call with this impression as well, is that cohesive strategy that really differentiates C&A from a lot of the other, amongst other things, but from a lot of the other traditional financial planning firms out there. Is that a safe statement?
Yeah, yes, Ron. I mean, it's the way we view the world too. I think Peter and I, when we got together years ago, and I was, he's been a great mentor and brother for me for many and partner for many years, but we always had the same view, which was the relationship capital was more than the financial capital. Mm-hmm. So when people come in and talk to you about probably one of the most important topics in their life outside of their faith and their family, right, and their health, finances is right up there, and they have concerns and they want to be heard, and they don't really, a lot of people, they might have a lot of money and they don't have a great understanding of even how it works, right? They may have made it in their business or made it through some other deals that they were involved in. So we want them to feel like family, and that relationship building and trust is the most important ingredient. And then we teach from there. I really believe that we're coaches. I think mentoring and coaching is such a big aspect of people's influences people can make in life. And I've had so many clients walk out going, either saying one of two things: I wish I met you sooner, right? This was different than I thought it was going to be, because I sat with 5 other people and it was completely different experience. And in a way, they sometimes say this: you're almost like a personal therapist for me around my money, because what you start to discover, and Peter talks about this a lot, the emotions around money and behavior really can put us, when we make decisions, can make us create ineffective decisions, especially at stress, especially when the economy's not doing well, or fears around us, which is, and it seems like every week. So it's important that you dive deep into the human being and then understand them so that they can understand you, and then you can move together in what I feel is a great partnership.
I'll tell you this much, Ron, what I've heard so much across the board from all different types of clientele is, Peter, the difference when it's all said and done is we're just starting with you, and the other people that I once used, it finished when we made the decisions. I felt like that was it. It was on to something else. And so it's a very long-standing relationship we have here. We don't believe or go into this thinking that we're stock market timers or pickers. In fact, if people wish to choose to do their own or use someone else for their so-called investment side of it, that's fine. We've concluded, and we've looked at numerous Nobel laureate studies that showed 80% of money managers underperform an index or an indice they're matched against. And so we don't think we're going to be anything different. And even those that are the 20% that do well, the next year or two, they're not in that group anymore. And so we take that approach. And when the market was very hot, Ron, people thought they were missing something, but by taking that approach. You sound like you're going to limit what I can make. But in the last 18 to 24 months, those that did follow that road are much happier now than people who didn't. And that goes back to some simple things, Ron, that I think are critical. I say this all the time. and I learned it the hard way myself. Less is more. I think the other thing that we try to rhyme home to people is we try to show them that what the world tells you you need and all for happiness is not necessarily true and many times false. And so we share the emotional side, as well as Dave pointed out. We talk about a thing that almost is taboo in general financial planning, and that's to discuss potential mental anguish. To sit down with a potential client and start telling them some of the things that can go wrong, even before they wrote the check or opened the account, most financial firms will tell you that's a no-no. Don't do that. You could lose them. But we feel that's a real critical part of being part of this whole plan, and that's having a mental ability to know what your risks are and what you can or can't tolerate.
Interesting. I want to circle back to something that Dave said at the very beginning, which is, again, something I've never heard a financial planner talk about. And it was one of the first things you spoke of, Dave, and that is the importance of finding efficiencies or saving. You know, I don't think that your typical financial planner brings that up right off the bat. And to me, I preach this to most anyone who ever cares to listen. I'm a big believer in, like Peter said, do less or do more with less, or less is more. How important it is to know how to save money in life and how to get more for less.
No, I listen, absolutely well said. Ron, I just read something of a study that was done a few years back, and it made this correlation between the wealth someone has on paper and their happiness. Mm-hmm. And believe it or not, in the United States, right, the number was shockingly lower than you thought. You'd think that the number has to be this big number. I'm not saying that wealthy people aren't happy or poor people aren't, you know, sad or whatever, but the number was somewhere in the ballpark of $75,000 to $85,000 a year of cash flow that comes into your life, if you understood the principles around how to manage money and things of that nature. Yet most people, I live in the state of New Jersey, on a $75,000 or $85,000 income, it's really difficult to have any sort of lifestyle. So we're going to teach how to optimize savings first, because if you can capture savings per year, and just like anything else in life, if I can increase that rate, you know, I'll often meet people that'll be saving 5% of their income. By the time they're with me 10 years, I want them saving 25% of their income, right? Because that's going to give them better choices down the road. And then it had nothing to do with the economy and the markets and interest rates. That was all important, by the way. And we're going to talk about how those work in your life. But I think the emphasis on savings was big to me as a young advisor of how can I move the needle for people, and it makes a difference over time. And it has, you know.
Interesting. Peter, I've heard you say in multiple interviews that seniors fear more about running out of money than they do passing away. Why do you think that's the case?
Well, I live in a 55 and over community, and once everybody kind of knew what I did, I couldn't walk into the clubhouse and not get a question or two, especially in the last 18 months. People have grown much more concerned. It is a fact. If you think about people that did plans 10 or 20 years ago or retired 10 or 20 years ago, those plans were based on a likely living age much lower than what now is happening. So that's been the one radical change. The other course is the cost, even though you're retired. People are recognizing now that Social Security is very, very dicey for anything, I think, past 5 or 10 years from now. In fact, I think if you're a worthy financial advisor and you were sitting with somebody under 40, the plan without any potential Social Security being as part of the plan. If it does, just consider that a good fortune. The other cost is when you get older, which I've experienced now firsthand, you realize not only can you not do all the things you once did, it's more difficult, but it's still quite expensive, even though you might have Medicare and all, but medical costs are coming high. And of course, the other challenges is when we've seen it now, look what happened to somebody that was on a fixed income the last 2 years. Their purchasing power dropped tremendously for everyday things, necessities, not luxuries. And so that is the fear of what people have. And when you have 2/3 of the workforce right now, Ron, working paycheck to paycheck, how are those people ever going to get to a retirement stage and then be able to live off their assets for that? And then there's another story I will say for another day, maybe another interview, and that's the coming battle of ages. And there's going to be one. People that are going to be 85 years old and say, listen, Medicare wants you to cover a lung transplant because I want to live a few more years. And a 40-year-old kid that's getting bled to death in taxes goes, no, don't let that old man get that. He's 85. Those things, believe it or not, are happening already. You just have to look to Canada to see that. So there are a lot of things, but Dave is one of the big things that Dave teaches is how to make sure you don't outlive your assets. And I let Dave expand on that.
Yeah. So it's critical to have balance as we go through life. No different when you exit the workforce and get into what I call your distribution phase of your financial life. There's this accumulation phase, and then you transition into the distribution. And some people can still accumulate in retirement, right? But for a lot of folks, it's figuring out the certainty of their cash flow. And we'll teach them a structure that has 3 components to it. One is a paycheck component. So I'll speak to this even from a business owner standpoint. One of the first shocks people get when they retire is, where's my paycheck coming from? Right? Every 2 weeks I was getting this deposited in my checking account, and now I got to make sure I have a system in place that's going to take over for that. And I don't know about you, but if you went to work every week and they said to you at the end of the week, hey, we're not sure yet, but we're thinking you might get your paycheck next week, but we'll let you know on Thursday, and you're getting paid on Friday, you may not be sleeping too well or enjoying that life that you thought you were going to have. So having that guaranteed income paycheck structure is important, and there's a lot of ways to do that. Having what I call a play check, right, which is the backup to say plan B, right? Let's say if plan A isn't enough, now we need to have plan B, because life happens to all of us. We have, I call it life events, whether it be good life events that show up or bad life events that maybe happen unexpectedly. We need the flexibility in any economy to have another source of money, when I call it a play check, to come out, because I want it to be play, right? For the most part for my clients, and I'm hoping having a great life, right? And then the third component, which is always critical, is liquidity. You'll never want to not have liquidity in your financial life, whether it's an accumulation or distribution. That's where you can find yourself getting in trouble. There's more credit card debt in the country now, right, than there's been in a very long time, maybe the most ever. And that happens through the fact, as Peter said, people live in paycheck to paycheck, and they don't have a lot of liquidity to support the rising cost of goods they're buying, inflationary costs in other areas. So that's a structure, and we dive much deeper than that. There's just a high level look that people start to go, boy, that gives me some balance. I have confidence in this, in the ability to do this. And then finally, this is just an experience. Peter's talked about as he's gotten older, we've all gotten older. I found there's like 3 stages in people that are in retirement. The first stage is their go-go years, where they're going, and their cash flow maybe needs to be structured in a way that supports that. I have a client I just was with this morning, 2 weeks in Italy, right? First time they're getting to go to Europe. So they're taking these trips now. Then I see them get into what I call the slow go years. When I walk behind my father now, God bless him, he's 78 and he's still doing well. He walks really slow, and my mother's yelling at him to pick up the pace, right? Because he's just not moving as quick as he was years ago. And then like my grandparents, when I saw them later in life, they were the no-go years. They didn't really go anywhere but to the local grocery store, their trip to the groups that they played cards with, or, go to the beach for a walk or whatever the case may be. But they weren't taking the trip to Italy anymore, doing those things. So understanding how life sometimes evolves, and that's not everybody. Structure and cash flow, again, is the key to help solve what those things may be when they show up.
So you can avoid a retirement financial plan of deciding to use your credit cards to finance retirement, right?
May not be the best plan.
That's not part of the plan. No.
Nope.
So a lot of my viewers, a good segment of my audience, are small business owners. I have architects, dentists, doctors. Just a good chunk of the people that watch my videos are either self-employed or own a small business. What do you offer them that might be a little different than, again, the typical financial planning model?
So Ron, great. Listen, really great component to what's going on in the US right now. More wealth is going to transfer in the next 10 to 15 years through the sale of a small business than ever before. So, and that's just businesses that have done well, that have now grown up and are mature and are looking for an exit strategy. So one of the first things we do is have a conversation around, first of all, the business itself, but we've created a 6-step process from start to finish to help a business owner start to discover where they want to go in terms of exiting their business, but then developing and creating a plan. And typically the first thing it starts with is what capital are they going to need to retire to the lifestyle that they want, right? And then secondly, believe it or not, the second conversation we have is emotional. If you've owned and operated your business for all those years, it's like raising children, right? And now they're growing up and having families of their own. It's emotional when they exit. And I had a client exit this year who was with me for 20 years. So I saw him grow from really a new startup to a very successful exit. And he cried, right, that first Friday that he wasn't in the office. And we had prepared for that, right? And he said to me, Dave, the business took care of everything in my life. I want to make sure that I set myself up so that can sustain itself. So that's a big part of it. Third is having the understanding of the different type of sale that's available to you for a small business owner. Right? The most common is typically an inside sale where it's upper management or executives or a family member that you've groomed, key employee, who's going to now take the role of the owner, right? And there may be a transition for that owner to exit, right? So you'll see that kind of demonstrated over a few years. What does that model look like? How does the owner get their capital out successfully, but still allow for the business to continue to move forward? The most common sale is really an outside sale. You get a liquidation event, private equity capitalization comes in and buys you out. And now you have a large check. And here's the question you got to solve for. Where am I getting my cash flow from this large check? Right. So we're having that conversation, Ron, about how to transition that from the business paycheck to the personal paycheck now. So that sale, there's things done commonly. Mid-sized companies do things called ESOPs. So we're involved in strategy around that, how the employees are actually going to own the business and how they can do it through their retirement plans. A very strong, but can be tricky process if you don't know what you're doing. Right? So there's those components. And then there's the valuation. Right? How much is it actually worth? We all tend to, when we own something, we all tend to think our personal residence may be more than what the market calls for, or some asset that we have. Business owners are no different. We have a business here. I think it's worth the world, right? But someone outside may say, well, this is probably what it's worth based on a multiple of EBITDA or some multiple in the industry. So that conversation is had. And then the final piece always is their personal planning. We're going to walk them through what life looks like so that when they exit, I want them to walk out with that smile, other than the emotion that they're leaving something they created, but have a true plan of execution that they can go into. And now they have more of a personal balance sheet as opposed to a business balance sheet.
I think it's also important, Ron. I think this is absolutely critical because that's probably the single largest component of our business is dealing with small to mid-sized businesses and exit strategies is don't wait till you're in the exit strategy to start your planning. The longer before you actually begin the process, the more opportunities and things are able for you to do. Once you've done that and all, then you leave yourself with far fewer avenues. So it's, even if you're not thinking it's coming, it's a good idea to get an idea what's available to you if you so choose to go that route. Because sometimes people realize their dreams, like Dave said, they thought their business was worth so much or whatever, or now they start planning, but 3 years from now, suddenly new technology comes in and what they do isn't, really critical. This artificial intelligence is going to be the huge change in this for business owners and all. How is that going to replace? Are they going to be, you're not going to be able to replace the electrician or get the robot to come in and all, but there's going to be certain types of businesses you own which you're going to be very replaceable with. And that's all just in front of us now. But I can't emphasize enough that you need to start your exit strategy planning before you actually begin the process.
Okay. Excellent. Do David, do you work with people across the United States, or is there a geographic boundary that you typically work within?
Ron, if you asked me that question 10 years ago, Peter and I would probably say we might have 5% of our clients outside of the Northeast. We're in the New York, New Jersey area, right? Now we're more than 60% outside of that region. So we have clients in almost every state. I was going through this the other day. I think we need Alaska still, and Idaho and Wyoming. There's only a few out there that we hadn't had someone move to or have a business in. So with the ability of technology, even prior to COVID, because of Peter's resume and him speaking globally and nationally, we were getting calls from people and they said, we'd like to talk to you, but we're not, in New Jersey. How would that work? And we created just a process online with us through video conferencing like this that makes you feel like I'm sitting in Ron's basement with him, and we can break down information and make decisions together, and then eventually get together, which is important, but it doesn't have to be right away. So yeah, more than half is outside of the Northeast now, and that number is growing. And I would expect 10 years from now, it's going to be even higher because of the fact that, I think we fit a family valued person regardless of where they're at in the country.
And you better watch it, or I'll drag you down here in the basement sometime.
That looks. I told you when I saw it, it looks good. Yeah.
Looking good. If someone wants to learn more, if they want to get in touch with you, what's the best way to do that?
The best is through me, Ron.
Okay.
Simply email me, peter@petergrandich.com. I'm on Twitter. You can find my blog page. Send me an email. We have a simpler formula. We send a very short questionnaire to you. We explain some things on what we do. You return that, and then we set up an initial consultation that's done just as we're doing here. And that takes about 30 to 45 minutes. I will tell you this, there's another difference between so-called traditional financial planning and all. Our process probably takes a minimum of 3, and depending on what's involved in it, 4 or 5 different conversations, meetings, etc. And if you were in the regular brokerage business and you had a sales manager told them you're taking 5 meetings with somebody before you see a check, they'll tell you, listen, you better shorten that. But so we're the turtles, but because we've had a chance to build our businesses and grateful for people like you to allow us to share about it, our business is 99.9% referral based. We haven't spent, I don't think we've ever spent a dollar on an ad to learn about us or come to some dinner and send out these invites,
Right.
Come for a free dinner and all. There's nothing free in the world. Trust me, especially if you go to one of those dinners. But reach out to me and we could take it from there.
Right. Yeah, the free jumbo shrimp, right? As long as you sign on the dotted line.
Yeah. Yes.
And I will put Peter's information in the description of this video. It's been great, Dave and Peter. I feel like I've learned a lot, and I think you've given some value introducing my viewers to what could be a great option for financial planning. Did I miss anything, or any closing comments?
No, first of all, we're very grateful that you're given that opportunity. Nothing is as easy as it sounds, but I can tell you this, because of where we are in the world and the things that are happening and the dramatic changes that are coming, especially with taxes and other changes to laws here in the US, it's very critical that whoever they may go with does this really full time. This is, not they're a financial advisor, but they also take people out to look at homes. I mean, that's just, you got to focus on one thing or another. And I think, especially with a group, because there's more than just us. We're partners, but we have a supporting staff of several people, and it takes them full time to stay on top of this and be focused correctly.
Sounds great. Well, thank you guys, and hopefully we can catch up again soon.
Yeah, I personally want to be there the day we take the $2,500 number down, but we'll save that for another interview.
That's right. Yeah, the bear has a blindfold on. When gold hits $2,500, the blindfold comes off, and Peter Grandich will be live in the basement with me.
Yes, I can't
You
wait for
got it,
that.
Ron. Sounds great. Thank you
All right,
very
guys.
much. God bless you.